In this week's show, what will impact future reverse mortgage borrowers? Hedge funds buying up homes? The Fed signaling earlier interest rate hikes, or signals of another housing bubble? Click on the banner above to thank the sponsor of this show, Fairway Independent Mortgage. Welcome back. In today's show, we're going to look at three specific market forces that will shape our collective future in reverse mortgage lending. First, the Fed. Last Wednesday, Federal Reserve Chairman Jerome Powell held a presser following a two-day meeting of the Federal Open Market Committee. Powell announced the Fed has moved up its projected interest rate timetable. Now, the Fed's dot plot shows there could be two interest rate hikes in 2023. The operative word is projected, meaning those hikes are far from certain. The market responded to the chairman's comments by the Dow dropping 382 points, then bouncing back as Powell pointed out those projections need to be taken with, quote, a big grain of salt. Barring some unexpected economic event, it does appear reverse mortgage borrowers will continue to benefit from historically low interest rates, perhaps well into 2023. That gives reverse lenders 2 years to maximize an ideal lending environment. And speaking of ideal, those selling a home these days, they may be selling their home to a hedge fund. The news of BlackRock's purchase of entire subdivisions and then converting them into rentals set off a firestorm of controversy. Many accuse the fund of blocking middle-class Americans from the dream of home ownership and instead creating a permanent rentier class. While the home buyers are certainly at a disadvantage when competing against an institutional buyer who are paying 20 to 50% above the asking price, some feel the reactions are overwrought. The BlackRock saga sounds grotesque, writes Atlantic staff columnist Derek Thompson. He points out that of the nation's 15 million single-family rentals, institutional investors like BlackRock only own 300,000 units. He adds, this outrage is misdirected. If we have any chance of fixing the completely messed up, unaffordable U.S. housing market, we should direct our ire toward real culprits rather than boogeymen. Who is the real boogeyman? It's our nation's shortage of housing and a lack of new home construction.
One of the biggest issues, the lack of homes for sale, 20% fewer compared to a year ago.
We've built fewer homes this last decade than any decade going back to the 1960s. So going into the pandemic, we were already facing a housing shortage, and it's just gotten so much worse.
Today, developers face the headwinds of soaring lumber prices and local governments that often block new housing developments. I would personally add that while many municipalities decry a lack of affordable housing, perhaps they should begin by removing unreasonable impediments to new construction and exorbitant permitting and development fees. All things considered, senior homeowners can fetch a handsome sum for their home, but they will face an overheated housing market and few listings to right size into their new house. Now, the good news is that those that choose to stay put, or age in place as we're apt to say, will find themselves able to extract more of their home's value than they were just one short year ago. Staying put does have its advantages. However, beyond interest rates and a lack of housing inventory lies another question. Are we in a housing bubble or approaching one? According to Bloomberg Economics, the warning lights are flashing around the globe. A cocktail of ingredients is sending housing prices to unprecedented levels worldwide, writes economist Niraj Shah in the report. Record low interest rates, unparalleled fiscal stimulus, lockdown savings ready to be used as deposits, limited housing stock, and expectations of a robust recovery in the global economy are all contributing. Now, Bloomberg uses 5 indicators to local markets' bubble ranking. Those are price to rent ratio and price to income ratio, to name a few. So share your thoughts on the Fed's monetary policy, hedge funds buying up properties or being market landlords, and a possible housing bubble in the comment section below. Also, please share this video with other mortgage professionals on LinkedIn, Facebook, and Twitter. Be sure to subscribe to our channel on YouTube and then hit the notification bell so you never miss an upcoming episode. Don't forget, you can catch your reverse mortgage news on the go with our podcast. You can find us at heckhamworld.com or subscribe and listen on iTunes. That's it for us. Until next week, happy originating.